Hello, everybody. Thank you so much for opting in to the green, yellow, red framework. This particular tool is designed to highlight three different strategies in which you can go into adverse market conditions such as COVID-19 and have three plans of attack which are going to result in your business being viable. This is especially useful when there are specific variables that are completely unknown and you need to have several different strategies because you don't want to miss out opportunities to pivot really quickly because you don't have a plan. And this COVID-19 pandemic is a perfect example. One of the biggest variables that business owners don't have right now or don't know is what is going to be the consumer discretionary behavior once the stay-at-home orders get lifted. What is going to be the proclivity for people to buy? Are they going to be scared? Are they going to stay in their homes? Are they broke? We really don't know. So the purpose of this is to outline three different strategies. Just as a disclaimer, this is not a financial statement. This is not going to accurately predict your cash flows or your GAAP revenue. There's accounting principles that go into effect there. And this is really just meant as a tool for you to think critically about your business, and it will hopefully force you to make some stronger decisions and have really clear directives on what needs to be happening under different frameworks. So with that, I'm going to go into the model. So the first step is to really get a data dump. Exporting your data from QuickBooks or another piece of your accounting software would be step number one. This is a data dump from RSI, which is an accounting software specifically for the hospitality business. QuickBooks is probably the most popular one outside of that. So just taking your P&L from a yearly basis, I would say trailing last 12 months of closed accounts, and then export it. And you should have a data dump that looks like this. From there, I would take your data and I would clean it up. For the sake of simplicity and necessity, I decided to model off of a restaurant from one of my restaurant clients, because they are going to be probably one of the most affected verticals after COVID-19. So really what you want to do is you want to take all of your revenue lines and all of your cost of sales lines and make them very easy to read, format them to make it extremely simple. If your business is not set up with a chart of accounts that allows you to easily see what your cost of sale is per each of your revenues or products, I would highly suggest you doing that. You can reach out to me. I know some very capable financial people that can recategorize your P&L relatively quickly and make it a little bit more streamlined. So, from a restaurant's perspective, really there's the main variable costs are associated with the sales from the food and the beverage, right? So the cost for the inventory for both the food and the drink, along with the back of house total and front of house total, the kitchen staff and the wait staff, along with other operating expenses, right? What would that be? Would include, maybe napkins, linens, laundry service, cleaning services, etc. All of these costs are associated with providing these products. These costs are going to be variable, meaning they're going to change depending on what the revenue number is. If you're going to have half the number of guests, you're only going to need to order half the number of food, right? Down below, you'll see the fixed expenses that don't change hypothetically month to month unless you change them. So the first order of business is to get your revenue and your cost of sale and your fixed expenses all on one line and one sheet, make it extremely easy to read. Again, I have people that can do this really quickly and easily for you. And then what I would do is I would calculate your contribution margin, meaning what is the margin for your food? What is the margin for your drink or your beverages on different lines? That way you can have a more granular look on what's going on. What is your back of house total as per a percentage of revenue, along with your front of house total. And once we have that, we're ready to operate the model. So as you see here, we have 3 different strategies. We're going to go on the green strategy first, and then I'll tell you how you can walk through that. And then you can look at, yellow and red and model it accordingly. So green, obviously being the best, we want to model the best possible outcome. We know that restaurants are not going to open to full capacity, either it be from regulation or consumer fears or consumer spending. So let's say best case scenario, we open up at 40% of what our previous revenue number is. Now, I think it's important to go into the point now that month 1 is going to be correlated. See, it goes to cleaned actual E6. Revenue is pulled from June, right? Most service businesses are seasonal. You want to make sure that you're not projecting month 1 to be January if in fact we're going to be opening up in June and July. We want to make sure that we have some kind of realistic apples-to-apples comparison on, if there is a seasonality fluctuation point in this model, that we capture that. So let's say that on a green light scenario, we're going to be increasing our capacity by 60 or by 10% every month. Sorry, typing and thinking and talking at the same time. And then in month 6, we're back up to 100%, and then stays at 100% after that. We'll see right there that it'll automatically populate these revenue numbers and the costs. Now, you'll see right here in this particular example, these margins for the back of house and front of house labor have not been filled in. That is because the management stated that they have PPP funds, so it's not going to be a cash hit to their balance sheet. However, that doesn't mean that they are going to have they're not going to not have to pay that. So I'm going to put that in there because I think it's important to distinguish that we are paying those bills. It's not like there's going to be no cost associated with those labor, but we might not have to go to our investors or our own personal pocketbook to take those in. So it's important to know that, when you go down in scale, right, you're most likely not going to be able to uphold the same cost structure. So this is where we take a gut check. Our front of house and back of house labor, the general manager forecasted at 8% and 20%. If we take a look at that in June, front of house was 4% and back of house was 17%. So he is erring on the side of conservatism. As this ramps up, you'll see that he is able to get some cost efficiencies there. Same thing here. Let's take a look and take a gut check on our food costs and labor costs. That's 38 and 30 respectively. In June, 33 and 18. Yep, he's erring on the side of caution, which is very smart. I respect that. And as a result, we have the total cost of good here and our gross profit down below. Right down below, we actually have our fixed expenses as well, and our net income or net negative cash. Take in mind, again, this is not a cash flow statement. However, kind of give us basically what our net negative cash is going to be for the entirety of the year. So if this is going to be our green light assumption, we're going to have to adjust our fixed expenses to make sure that we're cash flow neutral, or we're going to have to figure out how to come up with $75,000 ourselves or go to our investor group. So in this particular case, we have some rent relief. So I believe it was $5,500 out of the $20,000 for the first 6 months. So this allows us to take it from there. Again, this helps us out significantly. And we're not going to need the same amount of floor managers with the same amount of capacity. So we're going to be able to change our management structure, at least for the first 3 months, I would say. And as a result of that, we are actually more profitable. However, we are still working on a negative cash flow basis for a couple of months. So we probably still need to make some tweaks. That is where you will be forced to take a look at your fixed expenses and actually have to play with them. Maybe you don't have as many managers and you're actually working some shifts yourself. And that will provide you enough leeway to kind of go. All right, so that's around 68,000. And so again, you continue to play with this number until you get where you need to go. Now, also, another numbers you can play with that are going to make you critically think about your business is how much your food cost and your pork cost should be. This is an opportunity to renegotiate with your vendors. You can give them really hard data on how your business can't be viable unless some kind of relief is going to be made. Obviously, they do not want to lose you as a customer. This business, particularly $2 million. So having this data is going to be really helpful in renegotiating some of your packaging. Additionally, maybe this is going to allow you to go into your PMix and find out some more of the profitable items and be able to push and redesign your menus to be more profitable. So maybe that'll take your food cost instead of 38%. Maybe that'll take you to 30% or 28%. Be a little bit more aggressive there. And if we take that across, that changes our bottom line number considerably. We're down now more to a more fathomable number. So all gets driven from your capacity assumptions, and then you are able to run 3 different strategies. You can look at your management structure, your G&A costs, and your advertising, and you build your own strategy based on 3 different assumptions. I hope this tool was helpful for you. If you have any questions or concerns, please email me at david@davidpohl.com. Additionally, I am offering services to package these strategies up for you, help renegotiate your contracts, repackage your offerings, and I hope to hear from you if you need some help. Have a good one. Bye-bye.